Hi everyone, welcome back to another video. In this video, we're going to be looking at the top index funds and stocks to put into your Roth IRA for best compounding. The first one up here is VOO. As we all know, it is the Vanguard S&P 500 index. It has been around for quite some time. We can even look at the 10-year time frame. This thing has continued to go up. And if we look at the max return, it's 404.36%. And this is all the way back since in its inception date back in 2010. So it's a juggernaut for continuously going up. If we want to go ahead and look at the dividends, what's really nice about Seeking Alpha is we can see what the annual payout was $6.97. We can see the dividend yield is 1.35, which is not the highest. We can see that it's graded at a D plus and dividend growth is at a C plus. We can see where that compares to other areas. If we want to look at the dividend history, we can see on the max time frame that the dividends has continued to go up every single year. It's why I say it should be the foundation of every Roth IRA ETF that you put into your index funds, because this is where you want to actually start building your base off of, which is the 500 best companies in America. And if we come down to the very bottom, we can actually see what those percentages were since 2010 in its inception date, and we can see it has continued to rise every single year. The next one that I would recommend is going with QQQM, which is the NASDAQ 100. Now, if you are not familiar with QQQ, it tracks the 100 best companies in the NASDAQ. So we can look at overall performance. It hasn't been around this long because it's actually a lower expense ratio than the original QQQ. If we come and look at max time frame, it hasn't been around that long because that expense ratio we can see is nice and low at 0.15%, which QQQ is actually significantly higher, but we'll look at that in just a second here to compare. So we can see it's been continuously going up, and also the dividends has been going up quite high as well. Unfortunately, it is not the best with dividends because this is growth focused. It is at a D minus, and we can see per share what it's paying out is $1.25, and we can see the dividend yield at 0.62%. But we want to come here to the dividend history. I always like to come and look at the max, and we can see it's kind of a mixed bag. It has been increasing, but not as significant as VOO and the S&P 500. And we can come down and look at the payout history as well. It's another foundational, basically ETF, I would say, that you want in a Roth IRA. So remember I was telling you about that expense ratio at 0.15. Now this is QQQM, right? Let's go look at QQQ just so we can compare that expense ratio, and it's just a little bit higher at 0.20%. Now we can see this tracks the exact same things, but if we want to look at the dividends, this is the true amount that it's actually paying out for a long period of time. We can go ahead and look at the max, and we can see it has continued to increase every single year, which is what I like to see. Moving on to the next ETF here is VGT. If you are not familiar with this is a technology fund index. This is also through Vanguard, and what's really nice about this one is that it tracks all of the best performing tech sectors in our markets. So we can see the performance overall has been staggering since this thing has been its inception, I should say, back here in, let's see, basically like 2004 it looks like. That's the furthest this will go back, but it has continued to increase because of AI and other related things. If we want to go ahead and look at dividends, again, this is actually where it fails because dividends is not the point of this fund. It's for growth only, but it still does pay dividends. We can see what it pays out per year and what that dividend yield is, and we can go ahead and look at that history. So where is that history? It's kind of a mixed bag in this sense because this fund has changed over so many years. You can go back all the way to 2004. That looks like when this ETF actually came onto the market. It was 2004, and we can see what it was paying right there, and we can go ahead and go all the way to the very top, which is real nice. And then just remember that we can always look at the dividend growth, and we can see that it has continued to increase every single year. Move on to the next one here, which is SCHD, which I'm sure you all have heard quite a bit about. Let's actually go to the summary here. So what's interesting about this is that it tracks all of the best dividends, and what I like is that expense ratio is nice and low at 0.06. Overall, it's not too bad, but if we go to when this fund actually got listed back in 2000, 2011. We can see the compounding has continued to increase, which at 200%, it's not bad. Plus that dividends, let's not forget it. And what's really nice is the dividend yield on this is graded at a B. We can see what this was paying out per year, and we can see what that dividend yield is right there at 4.03%. And of course, always love to go to that history to understand where this is at. And we can see all that history of dividends continuing to increase, and we can actually see the amounts right there if we want to go ahead and look at that. All right, let's go on to the next one here. And this is where it's going to shake things up a bit. I want to talk about Bitcoin. So the first one is we're going to go to IBIT. IBIT, if you don't know, tracks Bitcoin directly. What's nice about this is the expense ratio. Again, let's just pay attention to that always at 0.25%. We can go ahead and look at the max time frame here. This particular ETF hasn't been around that long. As we know, Bitcoin is still getting adopted by the masses, so it's still a good time to jump in. We can see overall price return has been 115.26%, and obviously that will continue to skyrocket. This does not pay any dividends, unfortunately, and that is why I want to actually talk about the next one. And this is so important because Bitcoin is going to likely explode, and we want to capture all of that upside. So if we want to capture some upside, we can look up to BTCI. Now this is through NEOS, and what I really like about this one, and we'll come back to the performance in just a moment, but I want to talk about dividends. This actually pays the dividends every single month. That's what I like about it. Plus it is price appreciating. It hasn't been around that long, but we can see how much it's paying every single month, and look at that distribution: $1.12, $1.40, $1.45, and the amount continues to go up. Obviously it's been fluctuating because of the downturn in the market, but it's still a good fund to add, and I actually have this one in my Roth IRA. This is why I wanted to show you guys this, because every single month you are receiving a dividend and price appreciation from this particular ETF. If we want to look at year to date, we are unfortunately down, but we know why, and we can see where this has been going: 16%, and then one day. But if we want to go ahead and look at the 1 year, we can see when this thing launched back in October, it actually was skyrocketing quite high into December, and then has just kind of trailed off. That will change as we go into the future. Let's move on now to the next ETF, which is gold. And I want to pick this particular gold ETF because of its low expense ratio. That is also why I am bringing this individually to you, because I want to talk about that expense ratio. It's so important. Not a lot of people talk about it, but the expense ratio on this one is 0.90%, nice and low. And we can see in the past year, gold has appreciated 46.57%. I covered this particular ETF a couple of videos ago, so I would recommend watching that for more in-depth research about this. 30% year to date, which is just staggering. And then we can go ahead and look at the max time frame, which is 90.27%. That's just crazy. Unfortunately, no dividends for this, but you are hedging against inflation. That is what I like about this particular ETF. Let's move on to a couple of stocks now. I know I have covered this already with you guys before, but I still like them as long-term picks. This next one is RSG. The reason I'm picking it is because it is waste management and deals in the sector of basically trash pickup. That's always going to be around, especially even a recession, or potentially, I guess, even a depression. But let's not talk about that at the moment. So year to date, let's go and look at that because that's the most impressive one. It's 24.44%, and we can see in the 1 year it's continued to increase, 5 year, 10 year, and then if we look at the max, it has skyrocketed like crazy. And what's great about this particular stock is it's stable, and it also pays a dividend, and it has continued to increase over the time. This particular stock, you can see, is compounding like crazy. We can see the percentage that has gone up since 24 cents, and every single month it pays, or excuse me, quarter, it pays higher. So we can go ahead and look at the very bottom here and see every single quarter, because there are 4 quarters in a year, it has continued to increase, which is what I love. And this is a very profitable company. If you want to look at the financials, you can go ahead and look at it. Fortunately, Seeking Alpha kind of locks a few things. A good one to view this for free is TradingView. Look that up on your own time. So let's move on to the next stock here, which is going to be Berkshire Hathaway. Now, Berkshire Hathaway is a particular interesting one because this is going to give you exposure to Geico. If you don't know what Geico is, it is one of the largest automotive insurance companies in the world. And I like them as a company in particular, and this is the only way to get them. Remember, recession proof, let's cross our fingers, and depression proof as well, right? Because people always need to drive. Always want to be keeping this particular stock in mind. The only thing that this does not unfortunately provide is a dividend, no dividends, and we'll see what happens. But it could technically happen in the future, but we just don't know yet. For compounding growth and exposure to some of the best companies that Warren Buffett has been investing to in the past 30 to 40 years, I would buy some Berkshire Hathaway. And obviously he just retired, so we want to get some of Berkshire Hathaway into our Roth IRA. Let's move on to the next stock right now. My next stock is O'Reilly Automotive. The reason that I am picking this one is because, again, it's recession proof. People always need to be fixing their cars. I definitely see the mainstream media does not mention this company, but it is secretly compounding like crazy. 36% in 1 year and 247.58% in the past 5 years. And we look at the MAC, it's staggering at 42,439.38%. My previous video did a deep dive onto O'Reilly. If you want to know more about the specific company, does not pay a dividend, unfortunately. Maybe that will change in the future, but I just like it for compounding growth. It's quite amazing. And let's move on to my final stock here, which is going to be Sprouts Farmers Market. And I also did cover this particular stock because Sprouts Farmers Market is one of the only mainstream companies to promote organic food, which is starting to take off like crazy. Everybody's trying to eat healthy and live longer. We want to invest into these companies, and the price performance of this particular stock has been quite incredible to watch, especially from year to date and 1 year and 5 year. It's just staggering. No dividends on this. Again, that could always change. Those are my recommendations for your Roth IRA. Let me know if you have any more questions or want to talk about something specific. Drop it down in the comments below. As always, thank you for supporting the channel, and I'll see you in the next video.